So, you know me by now. I'd normally open up with some comments along the lines of a new month, a new all-time high, and then I'd briefly normally comment about the broader YouTube investing community, claiming that the impending collapse is just around the corner. Well, even though that is all true for this video, I wanted to take this one in a little bit of a different direction. I want to give you a list of reasons why, even after the insane run over the last 18 months, or probably more accurately, the insane run over the last 13 years, why you might still want to be bullish about future growth over the next 2 years. Don't believe me? Well, shortly I'll be giving you 3 reasons you really need to consider. And of course, after this, we'll be checking in on how my Vanguard account has fared over just the last 2 months. But before I do, I just want to give a quick shout out to my patrons who have stood by me even though I haven't done a single video for the last 2 months. Your support has allowed me to reinvest in a brand new camera, which is just here. I have no idea how to use it so far, but I'll have to figure that out. So keep an eye out for that over the next few weeks. So again, thank you. So here are 3 reasons why you still might want to be bullish, even after the market has gained 56% since the bottom of the pandemic in March 2020. The first one is personal savings. So basically, how much is the average person saving compared to their historical average? Are they sat there with nothing, meaning they've got very little to pump into the economy? Or are they sat on some fat stacks at the moment? Well, currently everyone is a little bit like Scrooge McDuck right now. For historical context, the average savings rate of the average Brit is around 8%, peaking around 15% in 1995, with a modern day low of just 4% in 1999. Coming into the pandemic, the average Brit was saving around 6.5% each month, which was around about the average, but this unsurprisingly shot up to 25% when we went into our first lockdown. So really no surprises. But we would expect this rate to suddenly drop once we'd come out of lockdown, right? Well, I would have, but between April to June this year, the average saving rate was just shy of 20%, which is over 3 times the average over the last 10 years. But the real question is, why does this matter? Why should you really care about how much your neighbour is saving at the moment? Well, in reality, the amount they're saving shouldn't, but what should excite you is what they might do with that money in the future. The most obvious one is that they will likely splurge this on businesses that you might own. Maybe a new iPhone, some new clothes, or some tat that they've seen advertised on Facebook. Who knows? But all of these things are going to drive the revenues of the businesses which you own right now. But this isn't all they could do with this money. Some of these individuals will be investors like you and me. And what do a lot of investors get trapped into doing? Well, it's saving money to buy the fabled next dip, which is just around the corner. Well, it always seems to be anyway. But for this, I'm actually not going to show you some scientific evidence to back this up, because I've actually got some context on my own. I have a WhatsApp group full of 7 of my mates who buy VWRL, so a bit of a shout out to them. But just 10 days ago, when the share price dipped in an hour from about 87.40 to 86.20, 4 of them bought the dip. And this is a group where I preach lump sum or dollar cost averaging all the time, and they still get trapped into buying the dip. If we extrapolate this out across the market, it means that when the market does dip, there's probably a boatload of cash waiting on the sidelines to buy it up, meaning that those initially lower share prices are quickly brought back up to the normal levels. But it isn't just personal savings you need to consider. This brings us to point 2 of our bullish case for the stock market, and this comes to business savings. You'll likely be aware of the impact on businesses over the last 18 months, with the vast majority having to take drastic action to prepare themselves for the very worst business conditions we've seen probably since the World Wars. People were literally stuck at home, unable to walk into shops or partake in any group experiences. Surely this will be a death blow for businesses, right? Well, it is. And this is why businesses have furloughed staff, which has saved a good chunk of costs for them. They might have cut back on other things like investments, maybe made some staff redundant actually, and they've probably happily accepted grants from the government to build a mountain of cash to help them stay alive. But the impact of this crisis hasn't materialised like we thought it was going to. We all sat here in September 2021 and most developed countries are pretty much fully open, with lots of goods and services having supply issues at the moment as demand has exploded. Just look at the computer chip shortage that we're currently facing at the moment, or the fact that McDonald's have run out of milkshakes, for God's sake. It's complete carnage out there. This is all anecdotal evidence. What about the cold hard facts? Well, here's some data that you can see from the S&P 500, which looks at the cash that the companies have on hand at all times, and it goes back to 2006. As you can see, it's been hovering around about 2 billion since 2010 up until 2020, but then since then the cash reserves have boomed all the way to £5 billion. But again, Why should that matter to you? Well, it's common knowledge that having a large amount of cash sat on your balance sheet isn't really a good thing in the long term. Firstly, it gets whittled away by inflation, and secondly, it should be out there doing better things. But with all this cash on hand which they might not need, how could it benefit the investors like us? Well, most business leaders are incentivized to create value for shareholders of their said businesses. They can achieve this by directly giving money to their shareholders in the form of dividends, or they can actually do this indirectly through a method called share buybacks, which have proven increasingly popular over the last 10 years. Share buybacks is where a business will buy some of their own shares back and basically burn them, is the way I think about it. If a company has 1 million shares and buys half of them back, it means that the remaining 500,000 shares are now worth twice they were before. Obviously, they could use it for other things like investing more into R&D, or maybe expanding their business into different regions around the world. All three of these options should benefit shareholders like us. So, based on this data, you could strongly argue that there might be £3 billion waiting from just the S&P 500 companies going into the pockets of its investors. And finally, let's talk about business earnings. Fundamentally, this is what really matters above anything else. Are the businesses that you own making more money than they were in the years prior? And are they steadily increasing their revenues and profits over time? If a company beats expectations, then there's a strong argument to say that the company is undervalued and it's a good time to buy that said company. Well, as it stands right now, about 9 out of 10 businesses in the S&P 500 are beating their expectations for earnings. For context, this is the highest ever percentage since records began back in 1994. 27 years ago. So if you think about it, we've been on a wild bull run for the last 13 years and analysts are still undervaluing the profitability of companies around the world. So all in all, those are 3 very strong reasons why we actually might see really good strong growth over the next 2 years. But saying that, I'm not naive enough to say that things can't go wrong in the market, which we only just saw 18 months ago. But on the backdrop of all the content on YouTube saying the market is going to collapse by 50% or something along those lines, there actually are reasons not to be fearful and actually reasons to be very optimistic about the future. If you think about it, the only thing that fear does is to keep even more money on the sidelines waiting for the next fabled dip, which goes back to point 2 that I've just brought up. If you want to know more information about why buying the dip is a flawed strategy, then I actually did a video comparing dollar cost averaging to buying the perfect dip a few months ago. I'll make sure I put a link on the screen now. I've got to say, the results of that study really did surprise me, and I'm sure you'll be pretty surprised yourself. But that's enough of reasons why you might be optimistic. How has my very own portfolio gotten on my Vanguard account? Well, for context, I've been investing since the start of 2018, which was 10 years into a bull run. Everyone back then was claiming that on average a recession happens around every 8 years, meaning that at that time we were 2 years overdue for another version of 2008. This would have meant it had been a bad time to start investing, right? Well, let's see how that's played out. My fund of choice is the FTSE All-World UCITS ETF, or VWRL for short. I do get asked a hell of a lot why I don't buy the Global All Cap, which is a fund that I really do like. It's just that VWRL is marginally cheaper. And the second question I get is, why don't I buy an accumulating version of VWRL? The short answer is that Vanguard don't provide an accumulating version of this fund. I do know they provide them on other funds, but I just trust Vanguard with my money, so that's where I'm going to be sticking my money for the future. So when we last looked at VWRL about 2 months ago, the share price was £86, which at the time was an all-time high. In terms of my account balance, we'd broken this £60,000 barrier at £60,205, which left me with a tidy profit of £14,000 since I started investing. In terms of what's happened since, I could quite literally recopy my script from July and replace all the numbers, as broadly the same thing has happened again. If £86 a share wasn't eye-watering enough, since my first ever purchase of VWRL just 3 years ago was £63, it's actually pumped another £2 to £3 a share more just in the last 2 months, and it actually hit £88.96 on the last day of August. It's truly unbelievable. This means that VWRL has gained £11 a share in just the last 9 months, and then you need to compare that with the fact that it only gained £14 between 2018 and 2020, a 3-year period. I've got to say, I consider myself very bullish, but my expectations with 2021 were it's going to be flat throughout the whole year, so my crystal ball is completely broken, just like everyone else's. So what does this mean for my account? Well, as of recording this, my Vanguard account is worth £63,823 and it's jumped £3,500 in value since my last update. At this rate, I might not be too far off £70,000 by the end of the year, but realistically, we could see a massive market sell-off and I could be below 50,000. Who knows? All I know is that I can continue with my direct debit each and every single month. It's worked for me so far. Anyway, that's all for this video. See you in the next one.